तिवारी जी सबको अनम्यूट कर दीजिए एक बार प्लीज। तिवारी जी
भैया गलती हो गई
जब ये क्लोजिंग So within 1 minute, we will start the program.
ऑफ है ना मेरा कैमरा?
हाँ वो स्टिकर लगा दिए बैठ से।
हर्ष भाई,
तिवारी जी आप बैकग्राउंड प्लीज कंट्रोल कीजिए। तिवारी जी
क्या नाटक है ये सब?
तिवारी कहीं ठीक है। हर्ष भाई प्रोग्राम स्टार्ट करें?
डेफिनेटली।
So, good afternoon, one and all. Today's session, Chairman and past Chairman of Indore Branch, Rajan Ji Goyal. Keynote speaker, CA Sumit Ji Sada. Indore Branch Chairman, CA Harsh Firoda Ji. Immediate past Chairman and Management Committee member, CA Pankaj Shah Ji. Senior member of the profession and my dear friends. सबसे पहले मैं आप सभी को दीपावली पर्व की हार्दिक बधाइयां देता हूं। दीपावली के बाद हम आज पहला VCM कर रहे हैं और साथ ही आप सभी से रिक्वेस्ट करता हूं कि कोविड की थर्ड वेव आने की हार्ट सुनाई देने लगी है और आप सभी कुछ दिनों तक घर से बाहर जरूरत होने पर ही निकलें। फ्रेंड्स, to build a better financial future, one should invest in business that can thrive over decades and reward shareholder fairly. To understand the investment philosophy, we have with us CA Sumit Sada ji for today's VCM on the topic of sustainable equity returns. Let me introduce him to all of you. CA Sumit Sada is founder and portfolio manager of Compound Everyday Capital, Central India's first SEBI registered PMS. He holds an MBA from IIM Bangalore and is a 3-stage rank holder, chartered accountant, and 2-stage rank holder, company secretary. Before starting Compound Everyday Capital in 2012, he worked as an executive assistant to the chairman, Anam Securities Mumbai. Before that, he also worked in sector-leading companies like including JP Morgan, Hindustan Unilever, and PwC. He has 15 years of work experience, which include 10 years of professional investment experience. His firm has delivered over 18% annual return since 2012. We welcome you, Sumit ji. Now I invite our branch chairman, CA Harsh Firoda ji, for chairman speech. Over to you, Harsh bhai.
Thank you, Gaurav ji, Secretary of Indore Branch. Respected CA Rajan Goyal ji, past chairman of Indore Branch. CA Sumit Sada ji, young and talented person, today's speaker. CA Pankaj Shah ji, immediate past chairman of Indore Branch. CA Bharat Sada ji, CA Deepak Trivedi ji, CA Ghanshyam Jas ji, CA Radheshyam ji Kaset ji, CA Sunil Kumawat ji, CA Nikhil Jain ji. Dear members, Happy Diwali to everyone. This is our first program after Deepavali, and what a perfect way to start a program which involves earning money, understanding market, savings. So welcome everyone in a program on sustainable equity returns. As you already aware that branch is celebrating its 50th year of golden existence, and today we have with us CA Rajendra Goyalji, past chairman of Indore branch, and he contributed to branch since inception. Sir, we welcome you today's program, and we would like to hear words of wisdom on that. Sir also involved in many philanthropic activities such as helping students for education and their fees, and he is doing continuous work on that. Our today's speaker, CA Sumit Sadaji, is very experienced and knowledgeable person on share market handling portfolio. His lucky number is 5 because I got to know that he got 5th rank in CA, CS, and university. He is my friend Pankaj Bhai is talked to Pankaj earlier also. We CAs excelled in every subject, but when it comes to equity market, we are in very less numbers and we are very less interested. So it's initiative of Indore branch to update members with market benefit to the members and their clients. Regarding announcement, it is a matter of pride for all of us that from today, all over India, during pandemic, we are organizing exams successfully. Our president, our council and branches working tirelessly to hold successful exam. Also, CP requirement of 20 hours now can be fulfilled through virtual CP meeting. So now we see CP limit increase from 15 to 20 hours, 5 hours increase, and that limit is up to December 31st. ICI allowed to hold CP program at branch also, but due to increase in recent corona cases, we will hold in virtual format only. At last, I request members to wear mask, take care of corona, follow norms, and enjoy hours. Thank you. Over to you, Gauravji.
Thank you, Harshbhai. Now I invite CA Rajendra Goyalji, past chairman of Indore branch and today's session chairman, to address the member. Over to you, sir.
सर आपको अनम्यूट करना रहेगा सर, आपका अनम्यूट किया.
थैंक यू गौरव जी, हर्ष जी, पंकज भाई, सुमित जी, आप सभी को दीपावली और नए वर्ष की बहुत बहुत हार्दिक शुभकामनाएं. आज का जो विषय रखा गया है जिसमें सस्टेनेबल वर्ड है, ये एक बहुत ही सारगर्भित वर्ड है, बहुत ही अच्छा शब्द है. हमारे शास्त्रों में भी कहा है कि ब्रह्म सत्य और जगत मिथ्या. इसका आशय यही लिया गया है कि ब्रह्म चूंकि नित्य है, सस्टेन्ड है, था, है और रहेगा, और जगत जो आज है वो कल नहीं रहेगा, तो वो मिथ्या है. तो सस्टेनेबिलिटी किसी भी जगह बहुत 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 जरूरी होता है. मित्रों, जो इक्विटी इन्वेस्टमेंट है ये प्रोसीजर वाइज तो बहुत सिंपल है, लेकिन परफॉर्मेंस वाइज बहुत डिफिकल्ट है. इट इज सिंपल बट नॉट इजी, क्योंकि दो बीमारियों से जनरली इन्वेस्टर्स ग्रस्त रहते हैं. पहली तो ये कि बिना मरे स्वर्ग चाहिए. कोई मुझे बता दे कहाँ इन्वेस्ट करना है और मैं इन्वेस्ट कर दूंगा और मैं कमा लूंगा, ऐसा सोच रखते हैं, जबकि ऐसा संभव नहीं होता है. सस्टेनेबल संभव नहीं होता है. एक आध ट्रांजैक्शन में हो सकता है. दूसरा ये है कि हर व्यक्ति चलती गाड़ी में सवार होना चाहता है, इसको एज ए रेगुलर एक्टिविटी नहीं बनाता है. और जब मार्केट ऑलरेडी महंगा हो गया है, गिरने के कगार पे आ गया है, जैसा कि वॉरेन बफेट ने कहा है कि ये घड़ी के पेंडुलम की तरह है, एक बार बाएं जाएगा तो फिर वापस घूम के दाहिने जाएगा. तो डेफिनेटली अगर हम इस मार्केट में लगे रहेंगे और सिर्फ चलती गाड़ी में सवार होना नहीं चाहेंगे, अगर इन दो बातों का पालन करेंगे तो हमारी सक्सेस सस्टेनेबल हो सकती है. क्योंकि मार्केट के बारे में ये भी कहा जाता है कि आपको बाजार में यू विल फाइंड few successful investors and you will find some old investors. But it is very difficult to find those investors who are successful as well as old. तो सस्टेनेबिलिटी चाहिए तो हमें इन दोनों चीज़ों का ध्यान रखना चाहिएगा। अब सवाल उठता है कि क्या 3-4 बातें हैं जो हमारी सक्सेस को सस्टेनेबल बनाती है। देखिए, स्टॉक मार्केट में जो भी व्यक्ति इन्वेस्ट करता है, उसका उद्देश्य पैसा कमाना होता है, कम में खरीद के ज़्यादा में बेचने वाली बात होती है। हम कोई स्पेक्युलेटर या ट्रेडर की बात नहीं कर रहे हैं, हम इन्वेस्टर की बात कर रहे हैं। तो पहली बात ये होना चाहिए कि हम कम से कम 5 और ज़्यादा से ज़्यादा 10 ऐसी कंपनियाँ छाँट लें, जो कि ग्रोथ के हिसाब से सस्टेनेबल है। अगर कंपनियाँ सस्टेनेबल रहेगी, तो हमारा परफॉर्मेंस भी सस्टेनेबल रहेगा। तो मिनिमम 5 और मैक्सिमम 10 कंपनियों से ज़्यादा बड़ा हमें पोर्टफोलियो कोशिश करके नहीं बनाना चाहिए। और ये वो कंपनियाँ होनी चाहिए जिनकी ग्रोथ का मतलब सेल्स और प्रॉफिट दोनों, टॉप लाइन एज़ वेल एज़ बॉटम लाइन, दोनों ही जिनकी सस्टेनेबल है, ऐसी कंपनियाँ हमने छाँटना चाहिए। दूसरा ये होना चाहिए कि हमें अपने आप को इम्प्रूव करते रहना चाहिए। बिना डीप थॉट के और बिना हार्ड वर्क के इस व्यवसाय में, इस इन्वेस्टिंग एक्टिविटी में हम सक्सेस नहीं पा सकते हैं। जे.आर.डी. टाटा ने भी जो उनके गाइडिंग प्रिंसिपल्स 5 बताए हैं, उसमें पहला यही बताया है कि नथिंग मीनिंगफुल कैन बी अचीव्ड विदाउट डीप थॉट एंड हार्ड वर्क। वॉरेन बफेट ने भी कहा है कि इन्वेस्ट इन योरसेल्फ। मार्केट एक्टिविटीज़ में अपना टाइम बहुत ज़्यादा लगाने के बजाय कंपनियों के रिजल्ट्स पे, कंपनियों के परफॉर्मेंस पे, कंपनियों के बिजनेस मॉडल पे, कंपनियों की सस्टेनेबिलिटी पे हम टाइम लगाएं और अपने आप को इम्प्रूव करते रहें, समय के साथ में, परिस्थितियों के साथ में, चेंजिंग सर्कमस्टेंसेस के साथ में अपनी इंट्यूशन को बढ़ाएं, अपने विजडम को बढ़ाएं और आगे बढ़ें। तो 3-4 चीज़ें ये हुई कि एक तो हमको हमेशा परफॉर्मेंस बेस्ड सोचना चाहिए। वॉरेन बफेट ने ही कहा है कि आई रिकमेंड 2 प्रिंसिपल्स फॉर द इन्वेस्टर्स। प्रिंसिपल नंबर 1, नेवर सफर अ लॉस, एंड प्रिंसिपल नंबर 2, नेवर फॉरगेट प्रिंसिपल नंबर 1। सो वी शुड ऑलवेज थिंक कि भाई हम जो कर रहे हैं, हमारा नॉलेज एंड हमारी स्किल, 2 चीज़ें चाहिए। जैसे हमें सीए प्रोफेशन में भी यही 2 चीज़ें चाहिए। अगर हमारे पास सिर्फ नॉलेज है, स्किल नहीं है, तो हम एक अच्छे प्रैक्टिशनर नहीं हो सकते। हमारे पास सिर्फ स्किल है लेकिन नॉलेज नहीं है, तो भी हम अच्छे प्रोफेशनल नहीं हो सकते। तो अगर इसको हम एक साइंस मानते हैं इन्वेस्टिंग एक्टिविटी को, तो हमें इन दोनों बातों की आवश्यकता है। कई बार हम एक कैजुअल अप्रोच लेते हैं कि चलो 1 लाख रुपया लगा के देखते हैं, पैसा मिलेगा तो ठीक है, नहीं तो 1 लाख रुपया चला जाएगा, कोई बात नहीं। इस कैजुअल अप्रोच से कभी इन्वेस्टमेंट एक्टिविटी नहीं करनी चाहिए। आगे सुमित भाई काफ़ी सारी बातें आपको बताने वाले हैं। मुझे हर्ष भाई ने कहा था कि कुछ मैं ब्रांच के बारे में भी बताऊं, तो सिर्फ 2 बातें मुझे कहना है। सस्टेनेबिलिटी हमारी ब्रांच में रही है और शुरू से, जब से ये ब्रांच बनी है 50 साल से, तब से ऐसे लोग और ऐसे सिस्टम्स इस ब्रांच ने फॉलो किए हैं कि एक परंपरा बन गई है अच्छाई की। और वो परंपरा, जब मेरे पिछले ने अच्छा काम किया है तो मुझ पे प्रेशर रहता है कि मैं अच्छा काम करूं। मैंने अच्छा काम किया तो मेरे बाद वाली पीढ़ियों को ये एक प्रेशर रहा है कि वो अच्छा काम करें और मेंबर्स की भी उनसे अपेक्षाएं रही है। तो एक तो परंपरा, हमारी ब्रांच में इतने सालों की एक अच्छी परंपरा बनी है। अब इस परंपरा में चूंकि अच्छे लोग जुड़े थे, तो कभी भी ग्रुपिज्म नहीं हुआ, कभी भी एक दूसरे की टांग खींचने का काम नहीं हुआ, और जो भी व्यक्ति मेरिट्स पे आना चाहता था उसको ब्रांच ने वेलकम किया है, मेंबर्स ने वेलकम किया है, और जो व्यक्ति अच्छा काम नहीं कर पाया किसी भी कारण से, तो वो स्वेच्छा से ही मैंने देखा है कि हटते रहे हैं। तो ब्रांच की परंपरा और ब्रांच का कोई ग्रुपिज्म नहीं है, और मेरिट बेसिस पे वर्किंग, ये दो चीज़ें हमारी ब्रांच की स्पेशल विशेषताएं रही है, जिसने इस ब्रांच को इतना सस्टेनेबिलिटी दी है। इन्हीं शब्दों के साथ मैं चाहूँगा कि आगे की कार्रवाई सेक्रेटरी साहब कंटिन्यू करें।
Thank you, sir, for enlightening us. Now, for understand science behind investing in equities, I invite today's keynote speaker, C.A. Sumit Sardaji, for a start technical session. But before hand over the session, I request to all members that they can ask their question by using chat option. But please avoid asking any specific stock. So try करें कि किसी specific stock के बारे में direct question ना हो. Over to you, Sumit sir. Sir, unmute करना पड़ेगा.
Good evening, everyone. Hope you had a very safe and joyous Diwali, and wish you a very happy New Year. Respected Rajan Goyal sir, thank you for your wise words. आपने बहुत सार्वगर्भित शब्दों में आपने बहुत सारी बातें कह दी, जिनको मैं कोशिश करूंगा एलॉबरेट करने की. इंदौर ब्रांच चेयरमैन सी हर्ष फिरोदा जी, सेक्रेटरी गौरव महेश्वरी जी, thank you for having me. To all the participants, thank you for joining in, and joining in especially on a Saturday evening and devoting your 1 or 2 hours. The topic for today's discussion is sustainable equity returns. While this might be an unusual topic to normal CPE seminars, but it is topical, as Harshbhai said. The difficulty level of the discussion is kept as a beginner level. I see many accomplished investors among the participants, and they might find parts of this session simplistic. But we also have very young chartered accountants as participants, and the objective is that this session is of interest to them. So with that caveat in place, let's dive in. Let me share the screen. Yeah. So we are talking of sustainability here, and sustainability presupposes a process, a system, a science. So let's try to unravel what are those principles. We all understand that investing is necessary, and equities are important instruments in an investor's portfolio. However, it is unfortunate that many savers today, including in our community, have a disconnect with equities. Many of us consider it as a gambler's pursuit, or a speculative exercise, and therefore many think that they are better without them. It won't be an overstatement if I say that there is a social stigma attached to equities today. I was in a party the other day, and was introduced to a gentleman, and he asked me, "What do you do?" I said, "Sir, I invest in stocks." Hiding pity on his face, he followed up, "And what else do you do?" So I realized my mistake, and now onwards I just say I'm a portfolio manager. So, but yes, it's right that many people have had mixed experiences with equities, including losses for themselves or for their clients, and hence that disconnect. But on the other hand, it's also true that if you look at history, the over 100 years of history in the developed market, including US, or 30-year history in India, equities have been the best for performing asset class since over long periods of time, and after tax basis, and they're also liquid. So we have this dichotomy. On the one hand, equities have been the best performing asset class, but the individual experiences of investors have not been so great. The objective of today's session is to go into this dichotomy, to try to solve this dichotomy, to understand the science behind investing, to see if there are any certain principles, sustainable principles that we can align to and lead to sustainable returns for our portfolio. At the end of this session, it is my hope that you would have learned a few ways to add 1 or 2% return to your and your clients' overall portfolio. And given that most of us have around 20 to 30 years of investment lives ahead of us, compounding creates magic over this period, and 1 to 2% excess returns can add to anywhere between 35 to 40% to the future value of your portfolios. Let me repeat, 2% excess return over a 20-year investment horizon can add 35 to 45% on the future value of a portfolio. That seems important. So let's dive in. A customary disclaimer before that. During the discussion, we'll talk about certain information which should not be construed as advice. You should do your own analysis and or consult your advisor. The stocks that we might talk about in these discussions, we might have financial interest, might or might not hold them. The topics or the things that we are discussing is currently based on our beliefs and understanding, and we try to improve our beliefs and understanding, and it might be possible that in future certain beliefs or understanding might turn out to be wrong. So that with that in place, let us set the context of equities in place before we begin. So equities are not just lottery tickets. They are partial ownership in business. When we own equity share, we own a fractional part of a live business. So in our mind, for this session and also when we invest, the association to the term equity should be a business. And what is a business? In simplistic term, a business is an activity that involves buying and selling, buying low and selling high. And while looks a simple activity, but I would argue that this is the source of almost all of the world's wealth today. The simple act of providing goods and services which others want has led to the prosperity, the ease of living of world of mankind since centuries. Many products and services that we use are business. This web conference that we are having is having on a software which is a business. The hardware that are using for this conference are a business. We as professionals are here to assist entities which are businesses. Countries that have prospered have created jobs, and those jobs are created through businesses. So businesses, especially those who can deliver value to their customers, grow over time. And they should be worth something if they are source of world's wealth. And partial stakes in those businesses should therefore cannot be just papers. They should be valuable. So this is the underlying science behind why a share price grows over time. An equity share allows you partial ownership in the earning stream and net assets of the underlying business. And if that business prospers over time, the worth of that piece of paper or the equity share should improve over time in the long run. Well, there might be interim volatility, but over a long run, changes in equity prices will mirror changes in the underlyings of a business. And since centuries, the general trend of mankind has been upwards. We want to move in a direction which makes our life easier, which makes us prosperous. And therefore, even it won't be an overstatement if we say that from today onwards also, it's a high probability that the direction where the country, economy, mankind takes is upwards. And equity gives that passport to participate in that prosperity of the world, of the countries, of mankind. So having set this point that equities should be construed as businesses, the question arises how to participate in it, right? Many people don't have time to understand businesses, understand stocks, markets. How is it possible to participate in that prosperity? Well, I'll argue that you don't need intimate knowledge of businesses, stocks, markets to earn reasonable returns from equities. In fact, I will say that you don't need any material knowledge whatsoever and do not have to invest any material time to earn average equity returns. Even your house help or your driver can earn an average equity return, whatsoever smaller the amount they want to start with. Now you will question, what are average equity returns and are they sufficient? Average equity returns are not bad. Let's benchmark it with an instrument which has been most popularly used for savings, and the chartered accountant community has rightly advised their clients to invest PPF, Public Provident Fund. And let's see how average equity returns have fared against PPF. So I will spend some time on this chart. This chart talks about returns from PPF from 1994 to today, span of around 26 years. And it also compares that with Nifty 50, the popular benchmark indices, which comprises of top 50 stocks in India. So if you had invested the maximum limit which was allowed, permissible under PPF as well as Section 80C, from 94 till today, you would have invested total 28.2 lakhs. Okay. I remember that in 1994, the limit was around 70,000 rupees and interest rate was around 12%. So if you had invested every year, today the corpus would have grown to 95.3 lakhs, an annual return of 8.8%. Extremely good returns. However, if you have not understood equities at that time also, and you would have invested a similar amount in Nifty every year at the annual top of Nifty 50, we are assuming that we don't understand markets and we would not have been able to time it properly. So even if you have invested in the market annual top of Nifty 50, then in the same period, for the same invested sum, our value of investment would have risen to 116 or 1.16 crores, annual return of 10.4%, which is higher by around 20 lakhs or 1.5%. Now, mind you, we are taking a very conservative comparison, right? If you would have been able to invest on an average basis throughout the year, your returns would have even be higher at 11.7%, or in terms of value, 47 lakh rupees higher. Now, just pay attention to the values, right? 20 lakh rupees in today's terms can buy a good car. 47 lakhs in today's terms can buy a good house, right? And the level of efforts involved would have been same. The attitude you would have adopted would have been same. Of course, you will argue that there are tax benefits to PPF when you invest. You get deduction on ATC. But the similar deduction also is available to ELSS, equity linked savings schemes, which you invest through mutual funds, right? So for that, from that comparison, we are comparing apples to apples, right? You can argue that the interest from PPF are tax-free, and today dividends are taxable, and even long-term capital gains are taxable. But we are comparing a period in which most of the period of time, dividends were tax-free and long-term capital gains were also tax-free. So even if we cut and dice it through various angles, we can see that if we had invested the similar amount with similar orientation of lock-in of 15 years, as that's in PPF, we would have done anywhere between 1.5% to 3% better than investing in PPF. Add to the fact that ELSS, or investing in equities, has no lock-in or less lock-in, maybe of 3 years, right? So it's possible to earn average equity returns, and those average equity returns are not bad. So anyone with lack of time or ability to discuss, to understand stocks and businesses can still do better by just buying average market. How do you do it? Index funds or ETF. Many of you would have heard of it. It's basically an instrument that basically buys the same stocks that are there in an underlying index. For example, if we talk about Nifty 50 index, an index fund or an ETF based on Nifty 50 will invest in the same stocks in the same weight which are there in the index without any discretion of any fund manager, right? So today you can very well earn market returns, average market returns by buying an index. That's one part of the story. Even if you had this knowledge that equities would have, maybe 26 years ago, that equities would have led to a better return than PPF, I would argue that many of us would not be able to enjoy that return because of this. Mind you, we're talking of 26 years, not 26 weeks or months. And these periods have seen many significant events. Right? There was the Asian crisis of 97-98, the dot-com bubble of 2000-2001, the subprime crisis 2008 and 9, and then COVID today. So we are talking of this entire period, and where stock prices and index level would have fallen by 40 to 50%, and many people would have left the ship. So what drives this behavior is emotion. Primarily greed and fear, and these are very powerful emotions. And I'll take these emotions as positively, because these emotions have been the source of supremacy of the human species over any other species. In fact, we are descendants of those who were fearful and greedy. Our hunter forefathers were smart people. Whenever there was hustlings in the bush, or when there was any smoke, they would just run because of fear. Or whenever there was excess food available, they would either overeat or they would store out of greed. Or those who could not do it perished. So generations over generations of generation of this compounding effect of greed and fear, we are descendants of those forefathers. So greed and fear is our legacy. And therefore, these emotions come up automatically. Whenever we are fearful or greedy, our heartbeats rise, the blood pressure increases, there is an adrenaline shot up. These are all natural reactions, and they occur especially when dealing with money. So when there is a mark-to-market loss, we are afraid. No price is too low, we just want to get out. Similarly, when the prices are rising and our neighbors are getting rich, there is envy and there is greed, and no price is too high. And this basically emotion-driven behavior is what causes problems. So what is an antidote to it? I'm not asking you not to be fearful, not to be greedy. That will come. That will come to us also. We have to have a system in place, a mechanical system that can bypass this emotional trigger, and that is investing a specific amount mechanically every month or two, irrespective of market levels. What is industry parlance is called as SIP, systematic investment plan. But that SIP requires a belief, conviction that over a period of time, human beings will prosper, country will prosper, and therefore, despite volatility, things will come back. So if we have this conviction in place and we do an SIP in ETFs, we are set for earning average market returns. So they're not bad. Right? But some of us might not be happy with average returns, and they would want to understand how to earn above average returns, or what we call as alpha. So if 2% excess returns over 20 years can add 35 to 40% to the future value of our wealth, imagine what 5 to 10% can do, right? And there have been fund managers who've been able to deliver 5 to 10% of alpha over long periods of time, making themselves and their clients wealthy. And in the fortune list of richest people, there would be people who had become rich purely because of investing by delivering alpha. So how and what is the science behind delivering sustainable alpha? Is there a way, core principles that we can adhere to to earn above average returns. And that boils down to stock selection. Right? In a passive instrument like Nifty ETF or index fund, no one is selecting stocks. Everyone is buying the index. That's the average, right? When you invest in average, you are on average. To earn above average, you have to do something else, and that is to buy stocks in a weights which are different than index. Broadly speaking, there are two schools of stock selection: a fundamental school and a technical school, right? The fundamental school buys stocks below their worth, and a technical school buys trends, momentums, things which are rising will keep on rising, those who are falling will keep on falling. For our purpose of discussion, we will focus primarily on fundamental analysis. Of course, you can mix it with technical analysis, and generally the experience has been okay or to good. So from the fundamental point of view or a long-term investing point of view, stock selection boils down to just two things. What we have learned over time: buying good businesses at reasonable price. Just two components to it: good business, reasonable price. And if we distill down this further, we can break it down into 5 points. Buying good businesses run by good management at a reasonable price. Not just one stock, we have to do it for a portfolio. So how to construct a portfolio, how to manage risk in the portfolio, and then how to avoid mistake on all the 4 point counts above, right? While avoiding mistake is being kept as fifth in the list, it should be the first one. But we need to avoid mistakes on these 4 counts. Hence, for the discussion purposes, I am keeping it as the 5th point, right? But in our mind, it should be the first point. So we are not just concerned with businesses; we are concerned with businesses that can be profitable. So business involves buying low, selling high. I will add one more thing from point of view of equity returns. We are interested in business that is buying low, selling high, and repeating this over and over. Why a business is able to do it? We are going to talk about that as the first point. The quality of business. While there are many businesses, certain businesses do better than others. Certain industries grow better than others. They're able to deliver returns on capital better than others. Why is so? When we are analyzing businesses, we are focusing mainly on 2 aspects: the growth of business and profitability of that business, a profitable growth. And this depends on 2 things: size of opportunity and competitive advantage. Size of opportunity is basically means there is long runway ahead of the company to grow its sales, to be able to serve more customers, more geographies, so that it can continue to invest capital in growing its business. Secondly, size of opportunity also means the company has significant market share or potential to improve its market share over time. And third, we are interested in businesses that have a tailwind, that is a support behind their back, not a headwind. Technology disruption, regulatory disruptions have kind of affected many businesses adversely. Film cameras led to digital cameras, which led to mobile cameras. E-commerce kind of disrupted traditional retail. OTTs today are disrupting the entertainment industry. So we are interested in businesses which are having a tailwind, which is not facing any disruption. These 3 things combine to give a size of opportunity which act as a source of growth. So we want a business that can grow. But all growths are not valuable. A growth has to be profitable. When I say profitable, it means it must be able to earn returns on capital which are higher than its cost of capital. Right? If cost of capital is between 8 to 10% in India, we are interested in businesses that can sustainably earn more than that over long periods of time. That comes with what is called as competitive advantage. The laws of economics dictate that any excess return will attract competition, who will cut prices and lower down the returns on capital from excess to cost of capital. We want businesses or we are interested in businesses that can create an entry barrier to competition. We call it competitive advantage. Warren Buffett calls it moat. There have been literatures that talk about this in corporate strategy, and they've used various terms to describe types and sources of competitive advantage. For our purpose, we are going to discuss around 5 to 6 as an illustrative list. And why? What is it which allows companies to keep earning higher returns on capital year on year and avoid the economic reality of competition? The first one in the list is low cost. Anywhere in the world, at any point in time, customers prefer things, other thing constant, at a lower price point, the lower cost. So companies that are able to provide goods and services of same quality at a lesser price point because of lower cost have an advantage from competition, because they can bear price-based competitions and still be profitable. Walmart did this in the retail industry in US. TCS has done it in India in the IT services because of the labor cost arbitrage. Low cost is also very important in a commodity-based industry. And Sri Cements is one of the lowest cost producers of cement in the world today. And these companies have been able to protect their profitability because of low cost. These examples are of companies for illustrative purposes. The company might have one or more of competitive advantage, and that's always welcome. But for illustration purpose, we are talking of only of single examples. Second advantage is habit, and this relates to especially things that human beings consume. So if we like taste of something, we are going to go back to it. It also applies to sin goods, cigarettes and tobaccos. So when a habit is involved, a person is going to go back to it. Be it Coke, for example. Many people who prefer Coke don't change to Pepsi or any other soft drink. Similarly, toothpaste. People who like taste of Colgate every day, every morning, don't usually switch because of this habit. So habits are powerful source of competitive advantage. Third source of advantage is high switching cost. If you have spent time and efforts on learning Microsoft Office, Word, Excel, PowerPoint, you know the shortcuts, you're able to do your work efficiently, it will be very difficult for you if I give you a Macintosh, Apple, because it involves a learning curve. And many people don't like it. Similarly, medical devices industry. Doctors learn to operate with certain devices when they work on patients, and these are mission critical equipments, and they have been trained. So they don't want to change it and learn new things. So there is high switching cost involved, and hence it becomes an advantage. You'll keep preferring a particular product to other because of this. The next set of competitive advantage is what we kept in one category is brand, patent, and license. Brand allows you to have a top of mind recall. It gives you a trust of repeated performance. So you go to it, especially for your high frequency, low ticket items like FMCG, brand becomes important. Patents. A lot of innovative companies want to ensure that they get some protection from competition because of the large amount of investments they do in research. So pharma companies, for example, get the benefit of patents, so that once a pharmaceutical product is successful, the regulations give them headway, a runway to ensure that only they are able to sell it. And license, a toll road license or a mining license, only that particular entity is allowed to run that business. So these are another set of entry barriers. The fifth and more relevant today is what literature calls network effects. In simple terms, it's basically when there are more users for a particular product, that products become better. Google, for example, a search engine, when more users come onto it, they share information, they share their preferences, and Google is able to tweak its search results based on that. And so more people find Google better than any other search engine. Facebook. Most of your friends and relatives are there on Facebook, so you go on Facebook and not any other platform. Network effects are also very important for exchanges. An exchange is a marketplace of buyers and sellers, and when there are large buyers and sellers, the prices are more efficient. National Stock Exchange, for example, has kind of monopolistic market share in equity derivatives today, despite being a late entrant. And last in this set is distribution, a pipeline of distributing or selling your products. So HDFC Bank was earliest to roll out large branch networks, ATMs, to raise deposits, to give lending. Hindustan Unilever, the FMCG company, has the largest network of distributors and retailers, which lend it the advantage. There can be many, there can be more, and they can operate in combination, which is always more powerful. So, not only should a business grow, it should grow profitably, and it should have these competitive advantage, one or more, that allows it to grow profitably. We'll discuss two case studies that elaborate our point. First is Nestle. The source of competitive advantage is brand and habit. Those who consume Maggi, Nescafe, KitKat, Milkmaid do not want any other product. Most of them, right? So the habit is a source of advantage. Brand. Many people recall the brands of Nestle because of years of investing in advertising by the company. So look at in this chart, look at the sales. Sales have continuously grown from 4,000 crores in December 2008. You might not be clearly able to see because the numbers might be a little smaller in font, but I will spell it out for you. The sales have grown from 4,000 crores to roughly 12,000 crores in a span of around 11 years, a growth of 9 to 10%. Importantly, the operating profit margin, OPM, has been rock steady at around 20% in all those years. This indicates that they have a pricing power because the raw materials that they might be consuming might have been going up or down in prices, but they're able to maintain those margins. Look at the return on capital on the bottom right of the chart. 40% plus return on equity for 10 years. This is very rare. So return on capital and growth tells us that this is doing something right. So this is one example of certain competitive advantage. I will take another example. CRISIL, it's a rating agency, credit rating agency. Credit rating is a licensed business. It's a regulated business. So the competitive advantage here is regulatory license. Not anyone can offer these services. There are 5 to 7 credit rating agencies, but top 3 have around 70 to 80% of market share, and CRISIL is the market leader. And there is long runway because anyone who has to issue debt has to take a credit rating, AAA, AA, and things like that. And Indian capital markets or Indian debt markets are still not so developed. So there is long runway ahead of it. Look at the returns on equity again on the bottom right, 30% plus. These both are a disclaimer, not recommendations. These are discussed only for illustration purpose of demonstrating business quality, sources of competitive advantage. Right. So we understand to extent what a good business looks like, a business that should grow profitability over time. But only that is not enough. We need to have a good management running that business. Because a business will go through challenges. A good management will, like a captain of ship, will be able to navigate that ship through those challenges. Not only that, it will be able to add to the competitive advantages, or as they say, strengthen the moat of the business. So management is important. Now, between the two, assessing a business quality and assessing management quality, while both are difficult, I would say management quality assessment is more difficult because it cannot be just quantitatively checked. So what we do is we focus on what management has done versus what they say. And what we look at is broadly 3 parts. There are many other parts also, but I think these 3 are important. And the most important is capital allocation. By capital allocation, we mean how the management chooses to invest the surplus cash of the business. There are 3 choices that management can have. They can do an organic expansion, wherein they invest in plants, machineries, working capital within their line of business. Or they can go for an inorganic, wherein acquire another companies, maybe in their sector, or some more adventurous management also try to diversify and buy businesses not related to their main business. Normally, organic expansions have proven to be more return accretive. There can be exceptions, but they have been proven to be more return accretive than inorganic. Focus has proven to be more return accretive than diversification. This is one. Second is how to choose to fund that expansion. The choice that management has is they can fund it through internal accruals, that is the profits left after all the expenses, or if the growth opportunities exist and there are not enough internal accruals, they can choose to use external funds, be debt or equity. Over large periods of time, we have seen that those companies which choose internal accruals to grow have added more value. And managements that have not respected capital, which have diluted equity capital to grow, or which have gone overboard with debt, have lost their flexibility to tackle difficult times, like today's, for example. When businesses are shut and cash flows are in profit, those who do not have high borrowings are able to survive and also repair. And the third, if you don't have you don't have growth opportunities like many industries would be in their advanced life stage, and they keep earning more than what they need, the best option is to return the capital back to the shareholders, either through dividends and buybacks. So broadly, you either invest in business, in return accretive projects, or you return it back to the shareholders. These broad principles of capital allocation can demarcate between good and bad managements over a period of time. The second input to assessment of management quality is the quality of accounting. All of us here are adept at this. I will not belabor more, but for our purposes, managements who want to hide can use shenanigans and the discretion allowed in accounting standards to shift profits from a year to there, to kind of overstate profits, the accounting profits. So therefore, the bypass to it is to focus on cash flows and more, not just cash flow, free cash flows. So if you look at cash flow statement, there are 3 components to it: the operating cash flow, investing cash flow, and the financing cash flow. We're concerned here with the top 2 part, operating cash flows and the investing cash flow. If a company is trying to overstate its revenue, it will show up in operating cash flows as negative working capital. Similarly, if a company is trying to overstate its profitability by overstating inventory, it will again show up in operating cash flows as negative working capital. So, companies where there is significant difference between accounting profit and operating cash flows, we need to be cautious. Mostly large, if you say large sets of companies, good companies and good managements, the difference is small between reported profit and operating cash flows. The second part, investing cash flows, we are, of course, a company if can generate positive cash flows even after investing in the business, nothing like it. But there are many businesses which are in the early stage of their life, and their investment needs might be more than what the business can generate. So it's okay if they are using the operating cash to invest, and therefore the free cash flows are negative initially. But we need to focus on what are those cash flows and are they reasonable given the opportunity of the company, the size of the company, and the return on capital of the company. Right. So This is the second aspect, and we move to the third aspect is respect for minority shareholders. So as a equity shareholder, when we invest, we are outsider to the promoters or the management who are managing the company. We want to partner with those management who treat us as partners with fairness. And there are various things, various inputs and pointers you can look at to differentiate between where do the management lie in the continuum of fairness. So first is managerial remuneration. The managerial remuneration should be fair, should not be very exaggerated. The management must be adequately remunerated for driving business. Their incentives should be aligned to growing the profitability of the business, not just the sales. We need to be careful about the way incentives of the management or the promoters are aligned. Second, many unscrupulous managements or creative managements try to siphon off funds through related party transactions. The accounting regulations have kind of tightened over time, so we can use those. There can be investment in subsidiaries. There can be related parties through whom a business is dealing. Any large related party transaction which does not, which seems out of normalcy needs to be investigated. And third is pledges. We want management to have, or promoters to have, the skin in the game, just like us. We want them to be the significant shareholders so that their fortunes are linked to ours. But sometimes, because of diversification, because of other projects, sometimes promoters need funds, and what they do is they pledge their promoters' holding to invest in some other projects. Normally, these pledges or the companies that significantly engage these pledges reflects that there is some issues with the management quality, and we should be aware of them. So, good business, good management, both are important. Good management is especially important for businesses. We are discussing two case studies which are more commodity in nature, two businesses where management quality has delivered significant wealth. First is SDFC Bank. You will all agree that banking is a commoditized business. You take deposits, you lend, you earn a spread. It's a boring business, a disciplined business. But SDFC Bank made certain choices that created vast amount of wealth. A, the underwriting quality reflected in long periods of very low, industry lowest gross NPAs. And B, investing in distribution and focusing on retail when everyone was focusing on corporate. Look at the profit growth, 20% plus over last 10 years. Return on equity, 18%, not bad for a bank. And all credit to the management because it's a fairly commoditized business. Well, there is an entry barrier, but there are a large number of banks which are not able to replicate this success. Second, another example of a commodity industry where management has done wonder is Shree Cements. Cement is a capital-intensive, commoditized business, amenable to cycles. The average cement industry margins hover between 15 to 20%. Look at the operating profit margin of Shree Cements. They've been north of 20%. In fact, touched 30% also. It's a capital-intensive industry. Companies grow by taking debt. Average cement industry's debt equity is always more than 1, but Shree Cement has grown only by using internal accruals. The borrowings have been kind of stable, steady, and they are less than 0.1 times equity, right? So two examples of commoditized businesses where management has done wonders. Now imagine when you have a good business and a good management, what can it do, right? But good management and good business both are not just enough. You need the third element, very important element, is a reasonable price. Because a good business run by good management, if bought at very high price, might not lead to reasonable returns. So here we come to the domain of valuation. to understanding the worth of a company and trying to buy it below its worth. But before even attempting valuation, there is a check that we need to do, and that is circle of competence. You might come across, companies that are touted as, it's a low price to earnings company or low price to big company. It's trading at 52-week low and it should be cheap. No. Before coming to that conclusion, you need to first check the circle of competence, whether we understand that business. Only when we understand the business, when we have concluded that the business quality is good, the business can survive next 5 or 10 years, grow profitability, and it has management that can protect its competitive advantage, can you then go into the next stage of valuing it. So if we understand a company and we are hopeful that it can survive next 10 years or so, we can go to valuing it. And broadly, mathematically or economically, value of a company is the present value of its future free cash flows. We just discussed free cash flow means operating cash flows less investing cash flow. We have to look, a valuation exercise is an exercise of looking in the future. But having ensured that we understand the business, we understand its driver, we are fairly comfortable that there is a future. We are now attempting to look into the future and conservatively, because we'll have to make certain assumptions about the future growth, future profitability, future capital intensity, etc., and try to discount it to today's values, and that we are not interested in a specific number, and a broad range is also okay. But the quality of the valuation will depend on the quality of the assumptions that you make. You change growth rates, you change terminal growth rates, and you change certain assumptions, and you can get any value that you want. So what we do in our firm is we use a form of a modified form of discounted cash flow method, which we call as reverse discounted cash flow. Simply stated, what we do is we do a goal seek. We try to put in assumptions that can match the value to today's price. And then we evaluate whether the assumptions that are going into the valuation, whether they are optimistic or pessimistic. We're interested in a scenario where even after putting in very pessimistic or conservative assumptions, we are getting a value which is at or below the current price. Sorry, at or above the current price. But there can be, because this involves future, and every person's valuation can be different from each other because it depends on the assumptions. The future can be uncertain, our analysis can be wrong, or we can be unlucky. So always we need to have a margin of safety. Therefore, we should try to buy businesses. Once we have understand and once we arrived at a conservative worth, we need to endeavor to try buy below that worth. But an obvious question is, if you have a good company and a good management, why will it be available below its reasonable worth, below its intrinsic value? Here comes the third part, which is Mr. Market. Mr. Benjamin Graham, considered as father of value investing, coined this term in his book, Intelligent Investor. This was around 1940s or 50s. What he's trying to say is, he's pictured, depicted Mr. Market as a maniac depressive fellow who comes every day. Some days he is extremely happy, ebullient, optimistic, and is willing to buy stocks from you at a very high price. Some other days he's extremely pessimistic, afraid, fearful, and he's not willing to buy from you even at a very low price. What Benjamin Graham Saab was trying to depict is emotions. Markets are market participants are human beings, and prices are set by humans who are affected by emotions. So that's why prices are volatile. If the prices were set by robots, you won't get 40, 50, 100% volatility in a year. You won't get 52-week high-low differences at such a high difference. So sometimes, and these are not very often, most of the time the market is efficient in pricing good businesses run by good management. But sometimes, because of hardships, ignorance, when the sector is out of favor or the company is out of favor, there is a recession or a pandemic, everything is painted with the same fear brush. All good companies and bad companies fell by 30, 40, 50%. Most of them in March, right? So sometimes you get prices which are attractive, and this volatility, while it can frighten us because it will lead to mark-to-market losses, but this should be seen as an opportunity. And Benjamin Graham says that you should see Mr. Market not as your master, but as your servant, and you should profit from him. Pages can be fall short of belaboring this point of how important paying a reasonable price is. It is a function of risk. The lower you pay for a good business, the lower is the risk, higher is the return. While again economics dictate that returns and risk go hand in hand, but if you are able to pay a low price for a reasonably good business, the risks come down and the returns go up. And this is the science of investing. If you're able to buy something which is good, which is going to grow at less than its worth, and you can do it repeatedly, more often than not, the returns and the outcomes will be good. Of course, there can be bad lucks, there can be mistakes, we'll come to it. But this is broadly the science of selecting a stock, what we thought to be optimal in current understanding level of ours. But we don't stop here, because we are not buying just one stock. We have to buy a portfolio. We just don't have one business, because we don't want to allocate 100% to a position. We need to have many such positions so that our risk is diversified. How much to allocate to a position, how many stocks to have, it's a function of many things. What is the horizon, time horizon? What are the quality of invest? What is the type of investors a person has? What is the conviction level? There are people who have done well holding 5 to 10 stocks, and there are people who have done well holding 40 to 50 stocks. So it's a matter of personal style. But any low allocation to a high conviction stock will not make overall difference to the portfolio, even if that position does well. So we need to position it well. And very high allocation can become risky, because beyond a point we don't know much, right? Anyone doesn't know anything beyond a point. So we need to have that humility and not to have very highly sized position. What if we don't have opportunities today? We do an analysis, we find a good company, we run by good management, but we don't find good prices. And that may be true in today's scenario. We wait, and therefore cash becomes important. How much you are willing to wait and let the money remain parked in cash equivalents, even if the market continues to become more expensive, from expensive to more expensive, is part of discipline and behavior and risk management. So it differs from person to person, fund manager to fund manager, but this plays an important contribution to overall management of risk and return. The next important part is, and as I said earlier, to be kept in the top of our mind is avoiding mistakes. Investing is a negative game. You don't have to hit sixes. You have to avoid getting out. It's a test match, right? And most of the time, there are around 1,600 listed companies today. Most of the companies might not pass through the filters that we have. All we have to do is avoid poor quality companies, businesses, not do certain mistakes. And that, if you are able to reduce drawdowns, reduce losses, the winners will take care of itself. So what are important mistakes? There can be many important mistakes that we should be mindful of. We'll talk about bottom two before, because for top three I have case studies. Point number D I will take first. which is a common mistake most of the retail investors do, is mixing insurance with investment. And this is something to do with the ATC thing and the lack of time. Most of the people believe that investing in an LIC policy which gives you 6-7% assured return is a good investment. No, most of the times there are two products mixed into it. One is protection and another is investment. Ideally, you should separate the two, buy only term plans for insurance purposes and buy equities for investment purposes. This is one. Second, point E, the last point, is investing based on tips or based on halo effect. Halo effect means a reputed investor has invested in this company, let's do it. Please note, tips or news about halo effect comes after things have passed, after the juice has gone away, right? Until and unless there is a conviction, buying on someone else's conviction doesn't pay. While you might know when to enter, you might not know when to exit. So we can materially improve our average returns if we try to avoid investing based on just tips and halo effect and do some work if we really want to select stocks. These two mistakes discussed, we come to three more prominent hazardous mistakes. The first is buying a company where the governance is in question, or buying outright frauds. This is linked to the management quality, right? A company where the management quality is low will look like a value investment, look like a cheap investment. The price will look cheap, but there is a reason for it. We need to see why the price is so low if it's available. Second category is buying poor businesses that either cannot go profitably. Those businesses which are facing some disruptions, they will also appear cheap, but they are not normally value, they are value traps. And third mistake is overpaying for quality, overpaying for good management, overpaying for a style, right? So let's discuss one case study each on these 3 points. We'll start with weak governance or fraud first. Everyone would have known about this company, Talwalkar's, the largest, it is closed now, the largest gym chain of India. This company was in existence, I think, 60-70 years, since 60-70 years, and had the benefit of the brand, the trust. If you have looked at its profit and loss statement, you would not have found anything untoward. The sales have kept on growing from, say, 20 crores to 200 crores. Operating profit margins have been stable and in fact growing. Profitability also growing. The company had also paid dividend. Less so, but yes, still paying dividend. What was the problem? If you look at the balance sheet, you realize the company was borrowing continuously. The borrowing levels kept on rising. And it was borrowing to invest in assets, to invest in fixed assets, gyms, other businesses. If you look at its cash flow statement, it will be very difficult to pick if something went wrong, because if you look at operating cash flow, the first line, it looks healthy. And if I go back to P&L, if you say profits, they were around 50 crores in March 2016, the third row from the bottom, right? And the cash flow from operations was 70 crores. So cash flows are healthy. But the problem is in this second line, which is investments. So company had been investing heavily into unrelated things, or having not so judicious with investments. So what the company was trying to do, what we could find, was company was overstating revenues to make financials look good and borrow. While the profits all ended up into the operating cash flow, means that probably they were overstating revenues by putting in their own money. And they were siphoning off the money by overstating capex. And then they demerged the business. So you note that I'm capturing financials only till 2016, because after 2016, they demerged the company. And then there was this Indian accounting standard which says that you can net off your accumulated depreciation with the gross block and only tell us the net block. And it became very difficult to track the assets. Moreover, the company made various acquisitions. It went and acquired gyms in Sri Lanka, in Singapore, despite a large opportunity in India, the company went and did acquisitions. And then 75% of the promoter stake was placed. So accounting and other related aspects can show that something is amiss. Of course, it's very difficult to pick these kind of frauds, but we need to be careful and not just rationalize that no. Company wants to invest, wants to grow, the runway is large, and therefore uh, it's okay if the free cash flows are negative. But where are you investing it? What are other circumstantial evidences along with this need to be kept in mind. So this is what the share price looked like. They listed in 2010. The share price is nearly zero. A case of mistakes on management quality. The second case study that I'm going to talk about is problems with business quality. And let me add some fun here. I'm not disclosing the name of the company. And let's see if we can find any issues here. This is the profit and loss statement of company XYZ. The sales have been growing from 1,000 crores to 2,000 crores. Operating profit margins rock steady at around 25% plus. Dividend payout quite healthy. So dividend yields were also good. It looks low in March 2018 because the company did a buyback and hence the dividend was replaced by a buyback. Okay, there might be problem with balance sheet or cash flows. The cash flows more than profitability, reported profits. The operating cash flows roughly around 300 crores is equal to or more than the reported profit. Investments less than operating cash flow. So this was a free cash flow positive company. Company continuously generating cash and returning it form of dividends. A company which is growing, generating cash, returning it to shareholders and earning decent return on capital, 35%, 30% plus. What can be wrong with this? This is the share price since the company listed in 2011. The share price fell from, let me give this, yeah. The share price fell from 400 to 80. And this was not because of fall in earnings. This was because of fall in the PE multiple, the price to earnings multiple that the company enjoyed from roughly 24 times to 5 times. So this fall of around 80% was purely because contraction of PE multiple by 80%. Which is this company? This is Dainik Bhaskar, DB Corp, a regional newspaper business. A newspaper business is a business which is facing disruption because of digital forms of news and advertisement. So despite being healthy, despite circulations growing, so there are two sources of revenue of a newspaper: circulation revenue and advertisement revenue. The circulation revenue and advertisement revenue both have grown for the company. People still like reading newspapers in India, at least. The company is able to command significant readership share, circulation share in all the geographies that it operates. The dividend yields are good. The profits is good. The management quality is good, not so bad. But still, we have a case where we would have lost 80% from the top, purely because this is a business which is facing a headwind. So there are many businesses today, while they look good, we need to be very careful whether they are fighting a very tough future. So retail is fighting e-commerce, entertainment is fighting OTT, etc., etc. So poor management quality, poor business quality will look cheap, but they are normally value traps. Third is the case of overpaying the price. I've taken a very extreme example here to illustrate my point. During the dot-com bubble, Wipro shot up some 100 or 200 times. And there was also included in leading indices. Anyone who bought during those times would have to wait for 20 years to break even. Why does this happen? Again, greed and narrative. At any point in time, certain sectors will be in favor, certain investment styles will be in favor, and the prices will be bid up on the basis of a narrative that this time is different. This is a sustainable company. You should overpay for certain types of companies, but we should always take those kind of narrative with a pinch of caution, because the only bulwark or only protection we have is the buying price. And unless and until we are disciplined towards this, there are chances that we are going to make mistakes. So, buying right business run by right management and not overpaying and ensuring that you're not making mistakes is the science, what we feel. If you can do it repeatedly over time, of course, there is a room for improvement, there is a room for mistakes, but over time, uh, even if you make 4 out of 10 mistakes, 6 out of 10 good things will drive returns. But those selecting stocks can see a system-based, a process-based approach to returns. Whether they are able to beat the benchmarks for long periods of time will be something which has to be watched out. But those who can explain their investment process scientifically, which has a element of repetition, then investing in equities is not speculation. It's science. It's basic economics. You're buying a dollar or a rupee for maybe 70 paisa, 80 paisa, a rupee which can keep its value. And so long as we are able to do it, that will render sustainability. So I've come to the end of our discussion, and I will summarize. So the sources of sustainable equity returns can be two. If you lack time or ability, average returns are not bad. You can do SIP in ETF or index funds, and your returns can be better than most of the other investment avenues. Or if you are venturing into stock selection, or you are entrusting your money to someone for earning above average returns, there has to be a process. We find that this process of buying good businesses run by good management at reasonable prices, managing portfolio risk, and trying to avoid mistakes can and has proven to deliver alpha over a period of time. And of course, why to have either or on? You can have both. You can have allocations in your portfolio for average returns also, for above average returns also. It's a matter of choice. So that's all what I had to discuss today. A note of gratitude to Indore branch of ICI for having me, to the participants for listening to me. We've used certain sources to describe our point. Thank you to them. And to the team at our firm who have worked behind this presentation today. Thank you very much.
Thank you, Sumit ji. We have some questions coming from members. The first question is from Kirti Maruji. What sectors you think would do well next in 5 years?
Hi, Kirti. Yeah, very difficult. When we buy, we buy basis bottom up. We buy a business that looks good. It's just after we end up buying, we look at the sectoral distribution. But over periods of time, there are few sectors that have continuously delivered returns. If you look at the list of the richest people in the world and look at the sectors or businesses that they've run, you'll find these common sectors: consumer, finance, technology, and some form of chemical, pharmaceutical, things like that. But there are also businesses which are outside these sectors and they've done well, and we have them in our portfolio. So it's again, the three things should fall in place: good business, good management, and good price, and it can be in any sector.
Okay. Another question is from Naveen Soodji. Nifty Sensex has only doubled during the last 13 years, from 2007 peak of 6,300 to 12,800 now. What kind of index return can we expect over next 10 years? I mean, it's again a presumptive question.
Yeah. No, so frankly, I don't know.
Okay.
But,
Sure.
but yeah, of course, we are at the top today, and future returns from a top cannot be very high, but I would say that interest rates are low today, so the bar that they have to beat is also low. So net of tax, FD returns are near 4%. PPF returns have also come down to 7%. So over the next decade, can they beat these alternative investments? Answer is high chances. I don't know. Depending on where we end the cycle at the end of a decade, we might be off a point or two, but there is high chance.
Okay. There's one more question. As you said that the interest rates are less today as compared to earlier, and PSU banks and not PSU banks, PSU for companies like oil, gas, other sectors, they are providing handsome dividend, more than the interest rate prevailing yield. So is it better to invest in PSU if someone wants safe investment?
We have to be stock specific again here and have a view on business, because many businesses have a headwind. We call it the ESG headwind. One, that oil, coal, these are fuels considered as dirty fuels, and businesses and world is moving away from these fuels. So whether they will be able to, get a PE rating, PE rating, I don't know. But there is another aspect is the issue with management, and so we don't know whether profit motive is the prime motive here. But if you are, there are certain exceptions, of course, to this general rule. If you find a business which is sustainable, management stance is profitability, why not? And because that government considered them as their piggy banks, the dividends might keep coming in.
Okay. Another question is from Meeta Ramchandani ji. For what amount of corpus should one go for PMS services rather than investing in mutual fund?
If I understand, you're asking the ticket size or the minimum investment for PMS.
Yes.
No, for regulatory limit is 50 lakhs today. It was 25 lakhs before January. It has increased to 50. So any participation in PMS requires a bullet payment of at least 50 lakhs. Mutual funds, yeah, a good question. Mutual funds don't have that limit. But issue is, just like stock selection, there are so many mutual fund schemes. There are around hundreds of mutual fund schemes within equities. Then there are debt, and then there are other instruments. Which one will you choose? How do you choose? You might need an advisor to choose a mutual fund. But your ticket size is low. Some fund managers are able to deliver alpha. But how would you choose it? You require some advice and guidance.
Next question is from Shruti Vedic. Reason for index to be at higher side? Nothing great is happening in economy as of now. So is this
We
is
discussed in our letter, and this is a fair point, that why there is a disconnect when there is a pain on the ground. But markets are forward-looking instruments. They are not looking today's pain; they are looking at future. The base case today is that COVID is behind us, or vaccine will be found. There is no lockdown, or maybe hopefully no lockdowns, and economic activity will resume. Profitability will resume. And for good businesses who have life of maybe 10, 20, 30 years, years of profitability gone doesn't affect their intrinsic values much. And this is one fundamental aspect to it. Another aspect is world over, the central banks have unleashed a lot of liquidity to the extent of 10 to 15% of global GDP. And global interest rates are near zero. So that money needs to be parked somewhere. And that money is finding place in equities. So hence, this forward-looking and liquidity can be attributed as the reasons for markets being ahead of economy.
okay. There's one more question from Nidhi Agarwal. What strategies to pick multi-baggers? Example like investor who applied for MRF a few years back.
So multi-baggers are only discovered in hindsight. Right? If we are starting from scratch today, the right way is not to think about multi-baggers, but right way is to avoid landmines. When we invest, when a person can invest, very difficult, given the nature of volatility, uncertainty, where can a company go? There are a lot of things to come in place, luck, strategy, the competitive scenario, regulations, etc., for a company to end up multi-bagger. But yeah, you own a company which looks good to you. Till the time it remains good and reasonably valued, you hold it. You end up with multi-baggers. You don't find it.
Okay, so I think we are done with the questions today, and I would like to thank from my bottom of hearts for presenting in a beautiful way from the entire Indore branch. I mean, the subject which you presented, the way you presented, fundamental analysis, technical analysis, and if we thoroughly study, it's somewhat related to like forensic audit we are doing. Like you presented 5-6 things, and if someone can study this. Bottom right and up sales right and the consistency, then members will definitely going to get benefit. So thank you for providing us so much of knowledge in 1 hour of time. We would like to hear again and again. Meanwhile, one more question can we take it, Sumit? Can
Yes,
we take
please.
it? Yeah. This is from Mayuri Paliwal. Hope we can. Okay, this is not a question, this is actually kind of knowledge to Indore branch. Hope we can continue this investment series in future, and definitely with Sumit we can have few more series of this later on also.
Sure.
So thank you Sumit for giving your precious time and providing us